I think there's going to be about 50% growth of these digital and algorithmic facilities year on year, from really good technology to be able to take unstructured data, structure it in a way that technology is easy to read, match it against available algorithmic capacity, and then quickly create it back to brokers. I think there's a real awakening now that the carriers realise that they can distribute more broadly at scale with better underwriting control and precision than ever before. So we need to kind of stop manually entering data and rekeying data over and over and over again.
Hello, everyone, and welcome to a new episode of the Insurance Distribution Podcast. I'm here today with David Dickson, the Commercial Director at InsurX. David, how are you?
Yeah, well, thanks, Martin. Yeah, thanks for having me on.
Please, it's our pleasure. Before we dive into InsurX, please do let me know how you got into the insurance industry, what got you, what trapped you, so that we can have a bit of a context about you.
Sure. I think, like lots of graduates, left university not really knowing what I wanted to do. So somehow found myself in the insurance market, not really having overly thought too much about it. Started working at Howden's operations team, quickly then found myself kind of drawn to the broking world, and so joined Howden's international financial lines team under Karen Allen, where I learned financial lines, professional indemnity, cyber insurance, intellectual property, that kind of stuff. And then, I did a couple of other jobs. So, left Howden after a few years to join a small kind of specialist cyber broker. After a couple of years working there, I actually got made head of the cyber team. So kind of threw me into the thrust of management at kind of the age of 26. So despite being kind of hideously underprepared for that, I guess, getting loads of things wrong, great opportunity for me, and I worked really closely with a fantastic market mentor in Chris Cottrell. So COVID kind of came along, and I think that was a walk in the road opportunity for me. Really, I thought, should I try something a little bit different? I went to go and work for a company called Superscript, where that was my first kind of foray into insurtech and doing things slightly differently, but I still kind of running the advisory and broking part of that firm. That was great. Worked with some really wonderful, gifted, entrepreneurial people there, and really kind of tickled this itch, I guess, or scratched the itch, isn't the phrase, isn't it, of wanting to do something slightly different in insurance. I took a bit of time off in between after Superscript with young children, and then joined InsurX as one of the commercial directors in June 24.
Excellent. So for those that do not know about InsurX, how would you define it? What you guys do in the market? Where it's that you operate?
Sure, we're an independent technology business, building and operating kind of smart follow, smart trading facilities, both with carriers on the consortia side, but also with brokers, building kind of tracking and algorithmic facilities for them as well.
So let's talk about a typical use case for the broker and for the carrier. Like, how would the broker be using the tool on their daily basis?
Sure. So there's a growing kind of wave of portfolio trackers now in the market. So where carriers want to access whole portfolios across different classes, and we're essentially providing the technology to be able to do that really efficiently and really quickly. So a broker will access the capacity, set up the capacity with their preferred markets, and we'll just do all the hosting. We'll act as the cover holder essentially in doing that. But the jewel in our crown and the technology is the algorithmic matching. So really good technology to be able to take unstructured data, structure it in a way that technology is easy to read, match it against available algorithmic capacity, and then quickly create it back to brokers. So brokers love it because they get access to follow capacity and even some lead capacity really quickly. It means they can spend more time elsewhere and with clients and with leaders, generating more revenue. Carriers love it because it's they get access to really live data. They get to kind of distribute more broadly and at scale, and they get to do it at a place where their expenses is really low as well. So it's a nice kind of part of the market trying to kind of digitize that kind of placement of follow business, especially.
So I usually like to see technology on how it was done before it, to try to find the gaps and how technology bakes in. So before this, let's put an example. The key marketplace happened inside, and it's still happening inside Lloyd's, actually. So you'll be traveling around, finding how you could be able to allocate a given risk. And the inefficiency was that as a human being, you're capable of meeting X amount of people for an X amount of time. And you may not know where to allocate the risk for the exact one. And the same happens on the carrier side. You might not be finding the right people to distribute your capabilities to underwrite. So when you get a technology together that kind of covers all this is where you gain the efficiencies. I am seeing this correctly, or what am I missing?
Yeah, look, totally right. Look, brokers are experts in being client advocates and structuring exactly the problem, like solutions for the problems they have, right? Carriers are really good at risk picking and kind of portfolio management and really understanding kind of how they can run a large financial organization with a balance sheet. But despite having kind of been trading together for 300 years, there's still a lot of friction in the way that works. And the friction comes out in two things. It's the speed at which things happen and also the cost involved in having to perform that. So there's a really nice opportunity here to and a really enabling opportunity for the market to deliver some technology to help brokers and carriers trade more efficiently together.
And I was wondering, like always in any type of marketplace where you have a demand and a supply, you always have, as a marketplace, the challenge to get both at the same time, right? Given your understanding of InsurX and what you have been building, what is usually the challenging part? Is it getting the supply with the carrier or changing a behavior of the broker that they usually did in some way and now using it, InsurX to do it?
Really good question. I think challenges. There's so many different ways we can look at it. But I think there's a real awakening of the market at the moment, where perhaps before there's a little bit of kind of skepticism about technology in the market, a little bit of platform fatigue amongst the brokers, and kind of like almost a bias towards doing the way that things have been done before. I think there's a real awakening now that the carriers realise that they can distribute more broadly at scale with better underwriting control and precision than ever before, whilst saving on their expenses. And the brokers are realizing that they can monetize their placements even further, expedite their placements of business into the market, and then also spend way more time doing other revenue generating things. And so I guess there's been potentially over the last few years a cultural challenge to this way of working, almost like how PPL and white space and placing platforms are now kind of accepted as part of the way of doing business. I think the smart follow way of working is now on the increase as well. And the LMA support that, and they've done lots of work on enhanced underwriting and the future of the lead follow relationship. And I think there's good tooling and technology and data now to ensure that carriers get what they want from it in terms of good overview, good insights, and good insights into indexation and how their capacity is being used on a daily basis. And brokers have better tooling, better data to ensure that they can represent their portfolio properly and ensure that what they put together through trackers or algorithmic capacity is best service to their customers.
And given your commercial role, this is coming from acquiring new brokers to the platform or acquiring new carriers to the platform?
Fundamentally, if we're working on a broker side facility, we'll talk to the broker and have a look at their portfolio of data. And so that they're the data provider there. And then they'll go out to their markets and say, this is our portfolio data. What do you want to do? And this is different levers you can pull, different things you can turn on and off. If it's a carrier side facility, then we're looking at that a leader's portfolio, and then having the same kind of conversations with underwriters there. So depending on which side of the kind of the business we're working on, whether it's a broker-led facility or a carrier-led facility, that's the answer to the question.
Gotcha. And would I be correct if I say that most of the risks that are being managed through the platform are quite large or specialty risks that are not like easy to get on the day-to-day market? Is this correct?
It's a wide range. So I think London is known for its large, complex risks, where it's kind of difficult types of business or really claims heavy or all of the above. But I think that's typically Lloyd's business today, and we're providing a lot of follow capacity for that. But I think on a tracking basis, it's very easy to provide that through the platform now. What's really interesting is actually when brokers are starting to realise now that 8 out of the top 10 brokers in London have a cross-class tracking facility, that the real value here, and coming back to how this can perform for SMEs, is the algo piece as well. So brokers are realising now that they can serve as a whole new portfolio of smaller businesses rapidly. Typically before, SMEs, a broker might receive a bit of SME business in and think, by the time I've gone around the market, I've kind of spent my commission doing this. And so how can I trade this more efficiently? Perhaps they previously go to an MGA, or perhaps they just kind of send it back. But the huge growth opportunity with Lloyd's now is that through structuring smart, efficient kind of follow facilities, it means that with a small bit of business now, a broker can have one conversation and then fill the rest of a slip up with smart follow capacity. This was a huge growth lever for London.
And I was wondering because of this, and now with this answer that is all types of risks, of course, it changed a little bit the angle that I'm going to ask. But as every technology, new technology that we integrate in our lives, there was a way before that we need to change, right? So there's a past behavior. Let's talk about the brokers that were doing risk allocation some way, and now there's a new opportunity to do with technology. Putting myself in the shoes of them, whenever I try new technology, I want to reach as fast as I can to an aha moment so that I can then say, okay, it makes sense for me to spend more time in the tool or trying to find new risks. What would you say is that aha moment in the broker? Is it like actually allocating the risk or finding options that they were never seen before, or another thing that I'm not even thinking about?
I think it's, London, a lot of the business done in Lloyd's in London is wholesale business, right? So it's done from other insurance brokers around the world. Those brokers around the world will want from London, they'll want really, really quick terms and they want good pricing. And it's quite difficult. London hasn't always been able to deliver on both those points. We've got the expertise, no doubt about it. But the way there's so much friction in the way that the business is transacted still, that it's been quick to win on speed and quick to kind of ensure that we can provide fully placed options for brokers and clients around the world. Now, the aha moment for them, I think, is that they can win on speed now. So where placement, large or small, might take days or weeks or even longer to complete, now we're talking minutes or hours, right? So they can really win on speed now, service more clients at a quicker pace. That they love that. Another thing is that they can do more with less. Where perhaps if there's an urgent kind of placement that needs to get done in 2 days, lots of brokers might say, right, let's do this together. I'll go here, you go there. Let's kind of get multiple people on here to get this done quickly. But now brokers will need 1 or 2 conversations with leaders who they kind of predefine and they know who their leaders are, and then the rest of this could be filled up with the smart follow. So it means they're able to get more done with less time on account. So their time on account is way shorter. And then lastly, through this placement strategy, because it's strategic, because they have access to these facilities that they've built with their strategic carriers, they're getting some extra yield, extra facility commission through this as well. So to summarize that, they're winning on speed, they're placing things quicker, they're doing way more with fewer people, and on each account, and they're generating more yield from it as well. So that's the aha moment is the combination of those three.
And I was also thinking a part of the traditional way of allocating risk from the broker perspective, given that they are defending their customer on the behalf of the carrier. There's a lot that usually happens on personal relationships with the carrier or MGA in turn, that it would be, okay, if I do have any problem, if I do have a heavy claim, I will be able to get to you because I know you, I spent time with you, I have like a relationship of trust built. In this algorithmic world or digital world, how do you surpass that conflict that, well, you might not have spent enough time with the carrier or MGA to allocate this risk?
It's a really interesting question. I think you've kind of hit the nail on the head in terms of perhaps a misconception there as well. Because whilst the nature of the relationship might change a bit, we're not suggesting that all of your friends in the market that you like trading with, and also who your clients have relationships with, we're not saying you don't trade with those anymore. Actually, it's like this technology enables closer trading with these partners. So whilst the relationships, the broker and placing relationships, might become slightly less tactical, and there's still elements of it. They'll still be talking risk by risk, but they'll also be talking a strategic element of, hey, Mr. Carrier, you provide me with this tracking capacity or some algorithmic capacity. This is the segment of the portfolio you're underwriting. Carriers should be are happier because they're tracking more of the portfolio, and brokers are happier because they've got a really strategic engagement with this carrier. And so there's no disruption to that relationship. If anything, it becomes far more strategic and deep set. So the power of the relationship is never going to leave London, but the type of kind of relationship driven by some data is just going to change it slightly.
Yeah, so like it's a complement to the traditional relationship that you're building. This is another way of just putting it more efficiently. That's what you're trying to compel over there. And in the end, the customer that has the risk, I understand it's winning because eventually could get better deals or better coverage or better conditions. It's faster. Anything else I'm missing? Like in the end, what we want to see is efficiency in the whole distribution chain, not only for brokers and carriers, but for the end customer. Like what are the benefits that you are providing to that end customer indirectly, maybe?
Yeah, you're right. It should mean faster placements. It should also mean like more certainty or follow capacity across the underwriting cycle. It should also free up the brokers to spend more time talking about kind of alternative risk structures if that client needs it. And fundamentally, some of these efficiency gains should start flowing back into the client's hands, either through better pricing or enhanced coverage as well.
Excellent. And with the now, of course, you mentioned algorithmic matching. This could or could not be AI. But with the rise of AI and in this whole chain that you are describing, when the customer has the risk, faster placement for the broker and better insights for the carrier to work with multiple brokers, how do you see AI impacting this whole chain? In which things do you think that things that are currently being done one way will change dramatically in the next 2 to 5 years? And we would say, okay, hey, do you remember how we were doing things in the past that we are now delegating to an AI?
If anything, the last kind of 10, 15 years has actually added more bureaucracy to the broker's workflow, right? 30 years ago, a broker would walk around the market with a slip, everything will be done on this bit of paper. But now a broker has, they receive an opportunity in via email, they've got to then key it into a system, into a CRM system, maybe even into a different system, a broker workbench, a policy administration system. They might even need to go and speak with their back office team, start drafting up slips and all sorts of other things. AI is a real place to play in how companies, brokers and carriers ingest data. Fundamentally, data that brokers receive is the vast majority of times unstructured. So structuring it at the moment is a human involvement and a human kind of step in that process. AI can do a far quicker, often a more precise, at larger scale version of that. So AI has absolutely got a place here for data ingestion right at that front part. Now, there's all sorts of ways that AI, I think, can probably change workflows and enhance workflows, but that's certainly one that we're seeing and working with.
Gotcha. And given this specific workflow that you're mentioning, and given the capacity to allocate risks faster, what role would you think brokers will play in the future? Are we seeing a threat for the broker, or where is the opportunity for future brokers to shine? Let me rephrase it. How do you think the broker of the future will look like, with higher capacity to allocate risks and higher capacity to, or higher speed to do workflows that they don't need to do manually?
Fundamentally, it means that brokers can do a broking job. So, brokers are either doing client-facing production jobs or client advocacy kind of advisory jobs, or they're doing placement. But actually, with this bureaucracy at the moment, they're doing a lot of manual work, a lot of system entry, a lot of administration. And so I think that's the part which this technology and AI can definitely help brokers with. Fundamentally, brokers are absolutely vital to this entire chain, because clients still want to speak, in the vast majority of cases, especially with large specialty complex risk, they still want to speak to experts. And so there's a reliance on the brokers there to be experts.
Excellent. So what you say is, if technology is correctly deployed, the brokers will be spending more time advising in their customer's location, office, or house, and not that much time in manual admin work that they're currently doing.
In their house is probably questionable, but yeah, absolutely, they should be far more client friendly. When we speak to brokers, we say, what are the things kind of holding you down now? What do you want to be doing? What do you want from technology? And they say that we want to spend way more time with our clients, and so we need to kind of stop manually entering data and rekeying data over and over and over again, because frankly, it's not what I'm paid to do. I do it because it's part of my job. There's no other solution. It causes friction in the work. It stops me from generating revenue for me and my business, right? They also say that I want a facility that is kind of truly differentiating, so I can really get out on the road and use that to kind of impress customers and deliver real value to customers. And they also say we really want technology that works. There's a little bit of apathy in the market about technology, because I think lots of insurance companies have tried to build technology themselves, and execution risk on that is high. Brokers need to carry on being brokers and excellent client advocates as they are. Carriers need to be excellent at balancing portfolios and underwriting risk and kind of managing those portfolios and those balance sheets. And there's a real role for technology here to help them just do that together.
Tied to this, there's another trend in the broker market that has been ongoing for a while, that is the consolidation of these. Do you think there's a space for consolidation to keep going on, particularly in the UK market? Or would you say, okay, it seems good where we are, there's going to be, of course, some consolidation, but not at the accelerated rate that has been going on for the last 10 to 15 years?
I'm by no means an expert in this, but it's definitely a really interesting question. I say that it's a very soft market, and I think there's probably more softening to happen. Brokers who typically work on commissions will find their static costs are remaining high, but their variable cost in terms of their variable income based on commission will be up to the pinch. So they've really got to work out ways that they can deliver more margin growth. Now, that will play out in a few different ways. Some will look at it as a good time to acquire other businesses in organic growth. Some will look at a good time that perhaps they've come to their own exit of their own journey. So I expect there to be a little bit more consolidation. It will be strategic. So it will be launching into new territories or consolidation of power between between things. I think one of the other interesting parts of the M&A cycle we might be in now is that people are reinventing and reimagining ways to access London capacity, whether they're broad brush, have a few different strategic partners in London to access the Lloyds, or whether they want to set up in Lloyds to try and channel things, or even whether they want to take on different investments in other vehicles to hedge some of their options there as well. There's all sorts of different strategies at play. So no doubt there'll be more M&A, more consolidation, but probably across all three tangents.
Okay, excellent. And finally, and thanks for all these insights and great conversation, I want to ask you, what are the kind of next InsurX things that we should look after and maybe touch base in 6 months to 1 year that you're excited about?
I think there's a market change going on, of which we're part of, right? Which is increasing amounts of the slip will be taken up by tracking and algo capacity. So this was great for the market because new business, London is somewhat lazily kind of renowned for being kind of slow and expensive. But I think London's got a great opportunity here because of its wealth of experience in this kind of tracker and algo space and the portfolio solution space as well. I think 8 out of top 10 brokers have portfolio trackers. That's helpful. That's a nice kind of statement prize that companies have built, and they work with their strategic markets on it. Really good. That might provide 20, max 30% of any one risk. And the key of the evolution, the change we're going to see, of which we're involved in as well, is that a broker will go out and get lead terms from a carrier, and they'll have a tracker, almost a participation at the top. That middle part at the moment is where there's still quite a lot of what we call kind of slow follow involvement. So it's manual follow business, where brokers are still kind of pounding the pavements, going to secure it. That slow follow will turn to kind of smart follow. So there'll be strategic broker facilities, either on a single class of business perspective or even on an algorithmic perspective as well, using kind of a multitude of the carriers they still use today. So that, I think, is where this whole market is moving. Slips are fundamentally going to look very, very different. And the LMA in the market agrees. LMA thinks there's going to be about 50% growth of these digital and algorithmic facilities year on year from now.
Well, exciting times ahead. Congrats on everything that you have been building so far, growing with a number of brokers and capacity to allocate. Looking forward to the next couple of months, years, to see where you're headed. But finally, shall we dive into our last section of the show, which is getting to know a little bit more about David, not only the professional, but also on the personal side. I'm going to ask 3 questions. If you're happy to reply with one short phrase, that would be great. The first, if you were to recommend a book, which book would you recommend?
Beneath the Scarlet Sky. Can't remember who wrote it. Excellent book about an Italian during World War II.
Okay, excellent. I don't have it in my list, so I'll check it out. The second thing, if you were to have dinner with someone, dead or alive, who would you pick?
Great question. I'm a very big rugby fan, so I'd probably say alive and Johnny Wilkinson.
Okay, nice, excellent. And finally, which is the band of your life, if you were to pick one?
Goodness, the Cranberries.
The Cranberry. Okay, excellent. Good things. Thanks, David, for this time. Amazing insights, as we said, and hope you enjoyed the talk.
Yeah, thanks very much for having me. Appreciate it.
Excellent. Until the next one.